morning, and welcome to the second hour of TheoTRADE. I am Professor Jeff Bierman. I'm broadcasting you live from Chicago, and today is Wednesday. It is October 2nd. It's 2024. Apologies, people. I have some technical issues, and everybody gets technical issues. I had to troubleshoot this, reached out. I've got it temporarily working, but once the behind the scenes today, I'll have to reach out to some greater technical support. In the meantime, we're going to do part 2 today. It's like a 3-part series of the fast and the furious, the systemic risks of algorithmic high-frequency trading. Again, the key operative word is high-frequency trading. And I'm going to try to back it up here because a lot of the graphics that I actually had pulled up were somehow, sadly, systematically kind of erased, and I'm trying to pull them back up. I may have to do it tomorrow because it's going to be a short today since I'm sort of 15 minutes late into the program. Don't worry, I will come back tomorrow with a vengeance. I will do my best today to get you through and give you a recap of what I've done. But in the meantime, let me give you a little bit of color on the market today. And I've said this time and again, and I'm not a permable. So I want to be abundantly clear to all of you. I'm not a permable. Okay? I'm an equal opportunity employer. But I got a model, and every time I veer off the model, I lose money. It's 100% I'll lose money if I veer off the model. So I just stick to the model. I detach myself from all of TV because I don't have any in the room. No radio, no headsets, no social media. I do kind of read research reports here and there, but I reserve the right to ignore fundamentals now because they don't work. You're in a market that doesn't care about fundamentals for now. I say the word for now because at some point they're going to care. They just don't care now. And I can't explain other than it's pure greed and it's pure nonsense. But eventually fundamentals do come home to roost. Like for instance, Don stole my thunder today. But you saw what happened to Nike. Nike basically had their new CEO at Pops. Everybody thinks it's all fixed. And the Nike warns they're going to have a 10% decline in sales. And they basically take it all back. Okay, so I am going to temporarily ignore fundamentals as it relates to this product for now, but there might come other time. Now, if you recall yesterday, I was the only bull in the room outside of Rosenblum. Corey and I are the only 2 bulls here temporarily. And I'm going to explain to you why, okay? A number of things have to fall into place. And I remind you, at some point during the day, the futures were down close to 30. They've come all the way back. I have figured out the secret sauce, and here is my secret sauce reasoning. The market is never going to sell off, ever, ever. The dippers are going to win every time until you break the back of the indicators. That's it. If the indicators break, we're not going up. And the indicators haven't broke. So the only indicator that broke was this channel. But that's the first line of defense. First, there's a second line of defense. And people are like, there's a second line of defense? Yes. The second line of defense, okay, comes all the way down to the next support level. So the first one's right here at 57.50, and we're clinging to it like grim death. Have we violated it? No. Then zip it. Calm down. Everybody is declaring the end of the bull market. We're not even close. The advanced decline's dead even. If you want a market breakdown, pray for a 90 to 1 day, 90-10 or 9 to 1. 9 stocks down for every 1 up. 90% of the volume down. We're not even close to a breakdown. Every dip is going to be bought forever until you break it. You have to break it. So don't count the number of candles. Waste of time. Stop listening to macro news. Waste of your time. Just watch the action. And when the indicators break, it will break. The algos only key off of technicals. They don't key off of fundamentals. And they don't key off of broken channels that much. They'll key off of the broken channel if the second one's broken and it's not. See how that's flattened out? That's not going to help you. Are you a bear? It's not going to help you. You need to go through the 50, through it to break that. It's not happening. You're 7 to 8% away. Number 2 is, has the MACD closed underneath the signal line? It hasn't. It's at the edge of the signal line, so all the edge goes to the bulls. I'm actually buying on the dip here on certain stocks. I'm ignoring this piece of garbage, useless thing because it makes no sense. All it does is it leads people to think the economy is healthy when it's not. There's no inflation. There's tons of it. It's a misleading product, so I avoid it like the plague. This is only a correlation product. That's the only value it adds for asset allocation. This is not breaking underneath. And even if it does break underneath, it never broke below the zero line. If it doesn't break below the zero line, you have no chance of the sell-off. Every one of you short today, you got burned again, and you're going to get burned forever. You've got to let it break. Wait until it breaks, then attack it. You're early. You're expected. It may run to 6,000 for all you know. You don't know. Also, the K and the D period are not below the 50. That's bullish, that's bullish, that's bullish, and that's bullish. Are you surprised it's up today? Because I'm not. I'm not at all. I actually stepped in and started taking off some short trades just to book some more handles and flip to the long side. I am not averse to buying here. I'm just not going to buy this product. But other products, they're out there for you to take the gander and buy them. This is not bearish. So stop with I can't stand the bearishness here. Stop. It's still bullish. You got to take out 5,600. You got to get underneath it. Then you got to break the zero line. You got to break the 50, and you got to break. We're not even close. Even close. Let me bring you another model. Just another model here. Okay. Spread it out and look at the PSAR. So the PSAR is showing bearishness because you're underneath the dot. That's a bearish trend reading. What's your problem? The momentum is still bullish here, and the trend is still bullish here. And now the Williams percent R is starting to reach an oversold condition, which automatically invites the dippers. The dippers are going to buy this every single day, every day for the rest of the year, unless you take out 5,500. So 30 points won't matter. 80 points won't even matter. I called it yesterday. I said, if we sell off 30, we'll rally. I told you, if we sell off, every time we're going to rally. The technicals have to turn. If they don't turn, I wouldn't short this product, but I would trade it intraday. If you think you can scalp this, go for it. Prove me wrong. Prove I'm a moron. Trade it intraday. I have no interest whatsoever. None whatsoever. Don't even care. Won't even look at it. Now, I'm going to skip positions today, and I'm going to move to the discussion at hand, which is high frequency trading. And I'm kind of like trying to, you have one of those things called restore screen, where you're going through looking for certain things I had earlier on here. And it's kind of gone by the wayside, but I'm going to see if I can steal like one or two of them that I had here earlier. And they really do like outline to a high degree. Here's one of them, because I want to talk about the kind of the risks that go along with high frequency trading and the mechanics of the risks itself. Okay. This is not the one. So I'm going to have to move to another one. Pardon me. I'm trying to grab some of the things I had in here, but my system crashed and it drew away a lot of my graphics that I wish I had back. So I'm kind of like flying it blind, because the graphics themselves do a lot of explaining that other things really don't work. So I'm going to be able to bring one to you, and one only so far in the midst here. Gorillas in the mist here, and see if we can kind of like make sense of this one. Let's see. See if I can open this image in a new tab and get it out there. There we go. So I've got one working for you. The others are going to have to struggle a bit. So I'm going to take you yesterday where I left off, because I left off yesterday. And of course, the title of the program, category first. Category is volatility, which means high frequency trading can lead to remarkable volatility, and it can lead to an absence or a dearth or a scarcity of no volatility. Because the idea here is the fast and the furious. Algorithms themselves are tempo controlled, okay? Systemic risks of algorithmic, okay? And it's high frequency trading, which is a subset of algorithms. We call them HFTs. So this is the beginning of yesterday's program. I'll bring it forward here, and we'll talk again, and I'll bring you a graphic into the idea behind high frequency trading. I just separated Three risks: systematic, non-systematic, and systemic. If you want to grasp all of them, you need to watch yesterday's program. So with the assistance of Brian Aponte, he'll reach out, he'll grab it, he'll post it, and we'll have it to see it. Systemic is what's known as structural risk, as in the algorithm systems themselves. Systematic risk has nothing to do with structure, and neither does non-systematic. It has everything to do with macro data and micro data and individual company catalysts. This is a different animal. This is literally the guts of the entire market. And I explained yesterday to a detail how the flash crash occurred, because it was all centered around one individual who abused his high frequency trading power. He was eventually, they caught him, okay, they put him and they prosecuted him. No longer going to be an issue. But the idea that we can't repeat what happened is absolute garbage nonsense. It can happen again. Don't kid yourself. I'm not saying it's going to happen today or it's going to happen tomorrow. I'm just telling you, it's going to happen again eventually, and there's not much you can do about it. You have to come to that understanding around like high frequency trading. So again, let me bring this to you again. So here are some of the risks. And again, I'll bring it to you again. Something like got in the way of this, and I'm trying to get it down to having one of those days, people. So let me get it here. I had some notes. Here we go. Okay. So my notes are here. I pull them up. I wrote them down. I'm going through my Microsoft Word, and I'm going to bring to you, okay, what we call the systemic risks of high frequency trading. These are just systemic risks, okay? And of course, I erased it. Risk system, algorithmic trading. You get the idea. Okay, so there are three major systemic risks involved in here. I will finish the last one, and then I'll jump back and explain to you, okay, the guts behind why this is happening. Intensifying volatility, which I explained yesterday, the ultimate ripple effects, okay, which you can't get around. And last but not least, which I didn't have a chance to get to yesterday, was the idea that there actually is, to a high degree, okay, uncertainty. And if there's one thing markets hate, yeah, well, it's uncertainty. Markets just cannot tolerate uncertainty at all. So algorithmic HFTs, high frequency trading boxes, they're a notable contributor to exaggerated market volatility. Just the other day, you saw the market drop 35 points out of the sky, only to bounce back and recover it. The downswing, algos. The upswing, algos. You saw it. You saw it intraday. You just have to go a few days back here to understand what you saw, and you can go back like 4 or 5 days and see it. That's an algorithm. Show it to you, okay? Want to see an algorithm? That's an algorithm, okay? That's an algorithm. That's an algorithm. That's an algorithm. That's an algorithm. You can see them. They're linear movements. They happen really in sharp angles. Sharp angles, okay? So algos affect all trades. But HFTs, what separates the HFT from a normal run-of-the-mill algo, okay? That's an algo, but that's not an HFT. An HFT exploits in milliseconds massive volume moves. So HFTs tend to be what's known as scalping driven, or they're what's called event driven. When there's just normal tempo controlled, okay, those are definitely algos. But HFTs literally are like on steroids. They're ridiculously fast. And by the time you move, it's like, oh my God, moves happen just so quickly, keying off of what could be a data point, cancel bids, gamma squeezes. That's like the genesis of this, okay? Now, let me take you back over to what I had here and talk about, okay, uncertainty. When a market suddenly collapses, which I just showed you, investors and traders, they're left wondering about the reasons for the dramatic move, okay? So during this news vacuum that often exists at such times, large traders, especially high frequency trading firms, okay, they will cut their trading positions to scale back risk. So when you see something dropping out of the sky, oftentimes it drops because liquidity disappears. And it's not always a flash crash. It's just firms are just scaling back their buy orders, dropping and sucking out liquidity, okay? Because they don't want to catch a falling sell program. So can that happen now? Yes. Am I predicting it? How the hell can I predict it? I have no idea. I could blink and that could be down 85 points. With news, with no news. Nobody knows, because the algos are working at ridiculous fast speeds and they're designed to curate their order flow. In, out, cut back on the downside, press the pedal, lean into it on the upside if they're long. They're tempo controlled. So fast, like movements, these fast and furious movements, okay? Big swings, 30, 40, 1%. That's not you. That ain't me. That ain't BlackRock. Those are high frequency boxes you're watching. They are little suckers. They walk in and they move quickly. They pounce. You can't react fast enough. You can't buy equipment. You can't do programming. You can't run. Don't even try. Okay. It's a massive amount of brain cell power, capitalization of money in faraway places that you'll never see because nobody's going to talk about it. It's like a skull and bones society, but they're out there and they're always surveying the markets, and they're not going to ever go away unless they're like officially or legally banned. So just be aware of that. So as markets move lower, okay, more stop losses are actually activated. And this negative feedback loop creates a downward spiral. That's what you'll see with an HFT on the downswing. If a bear market develops, which we're not in, we are not in a bear market. And I want to be like abundantly clear on that. We are not in a bear market. So like, let's like drop that noise, because everybody's saying we're going to roll into a bear market. We're not even close to a bear market, as if you never knew what a bear market even was. We're not even close. A bear market means you'd have to take out literally from this point on 4,500. So we're, you're 1,000 points away. So let's just pump the brakes on this and kind of like dial it in, because we're not even there. But because of this negative feedback loop, the consumer confidence is shaken by the erosion of stock market wealth and the recessionary signals emanating from major market meltdowns. So I always tell you, it starts with an economic event and then it transitions into a market event. That market event tends to be the high frequency trading. And the thing is, if you're going to be in this business, you're an investor or a trader, okay, you have to just, I call it, deal with it. You can't, Robert F. Kennedy, I'd rather light a candle than curse the darkness. Do I like them? I hate them. They distort, they manipulate, they rig the market. But at the same time, I can't get rid of them. It is what it is. It's like, you want to live with cars and you're like, I want to get rid of exhaust. You can't have it both ways. You want a car, it's gas powered, you're going to get exhaust. But the car gets you where you want to go. This is what you have now. You're going to get wild swings periodically. Sometimes these wild swings from the HFTs are going to bounce and save you. In some instances, they're going to wipe you out. They're going to kill you, and you're not getting your money back. It'll go down like this, and you're going to wait for this, and this zig is not going to come. That zag is not going to repeat after that zig. You think it will, but it won't. So that's kind of one I want to throw out there. Now, I have a graphic that I searched high and low for, okay, that really delineates and makes sense of how a high frequency trading works. So this is a 3-day program. I'm extending it a little bit further. So bear with me as I kind of like walk you through this, okay? So here we are. The broker placed the order, okay? That's what the broker does on his computer, right? And it's just milliseconds for it to be entered in the system. It goes into what's called a high frequency access point, or into a high frequency company. So you're going from the individual to the server, or what's called the nearest exchange to the server. Then it's routed. By the time all of this happens, it literally happens in milliseconds. By the time you blink, all of this is done. It's latency. It's a turnaround system. You can't see it. It's electronics. It's technology. It's so fast, it's unbelievable. So the broker might place an order to buy 70,000 shares on company XYZ at a certain price range. No single exchange has enough sellers near that price. So what do? So the order has to be split to several different exchanges. That's why Don calls it a farm. It's a VWAP spray. You have to complete stagger and split the order. 70,000 shares will never be filled. It's going to split and go 500, 500, 10, 20. They'll split it into multiple and fire it off and route it to millions, thousands of exchanges out there until all of it is matched. So if you want to sell, you want to place a buy, all those cells will be split into multiple trades. Could be thousands of trades, could be hundreds of thousands of trades if it's a one lot. You just don't know. So the HFT pays fees to quote unquote camp out. People are like, what does that even mean? The term camp out is a fancy word for a liquidity provider. It camps out. It actually puts in a bid or offer and says, I will buy here and sell here. It's a bona fide hedger. It's a bona fide liquidity provider. That's what an HFT tends to do. And it sets up what's called supercomputers as close to the exchange as possible, because the closer you are to the exchange, the faster the order will be routed, even if it's done electronically. This will save milliseconds off of time. It takes signals to get to the exchanges and allows HFTs to see orders sooner and place orders. So what's happening in Chicago is we started in the outer suburbs, and now all the HFT firms are actually on Michigan Avenue, a block or two away from the actual CME, okay, which is on Wacker Drive, just near the Chicago River. It's like a block away. So you have all these HFT firms. You had Citadel. Citadel was right, like a block away. I believe they were on Clark, or they were on Wells, which is a block away. Citadel is now in Florida. But at the time, Citadel was as close as you could be to fill paper to get the HFTs done at their high-frequency trading division. Closer you are, the more likely you are to grab order flow and execute, okay, and make the spread. That's what they do. The third thing you realize, and look, it says 5 milliseconds. And when I put in perspective 5 milliseconds, you really have to digest this. That's not even 5 milliseconds. By the time the order is placed, again, 5 means it's 1/1000th of a second. So 5 milliseconds is 5/1000ths of 1 second. So it's like, what? You place the order, and by the time you place the order, all the information has come back to you. But you click, and it's done. It's almost like it's done before it's clicked in a way. The broker's order will get to the nearest exchange, right? It'll be routed. They have an optimization program. But this is where the HFT computers see that a large order may be in the works. So the larger the order, the more they have to split the orders up, because one large order, if you take it in bulk, is too risky. They have to spread it out to VWAP average it. So they actually cut down the risk, right? Because one large order taken with a gap creates slippage and a huge loss. So they slice and dice it up, because by spreading it around, okay, it creates anonymity with transparency, and it keeps the liquidity humming all the time. Because one large order that is filled could scare away the crowd. Oh my God, who's selling 100,000 shares of this stock? Literally, all the bids could cancel at the same time, create a gap, and the bid offer spreads, and that stock will crash. To keep the stock from crashing, the HFTs have to split the order up to keep everybody calm and to provide liquidity so there's no gaps created. If that happens, you get a flash crash, which happened in 2010. So the HFTs recognize that when larger orders come to one exchange, it'll probably mean that's what's called similar orders are on their way to other exchanges. They use their own super fast fiber optic cable lines to reach the exchange, and the HFT computers race ahead of each other to buy stock at a lower price and then mark it up and sell at a higher price. The idea here is this: to run an operation like this doesn't cost millions. That's a lie. It's hundreds of millions. A staff of people, millions of dollars worth of computers, rent, fiber optic cables, okay? Then you have fees to pay. Then you have like surety bonds to pay. It's just a staggering amount, okay, of cost outlay day by day to run something like this. Okay, you got to lean on a Merrill, a Goldman, a Morgan, a BlackRock, a Citadel. They have the capital to do this. You and I, you can forget it. Unless you're Jeff Bezos, don't even go near something like this, okay? It's ridiculously complex and fast. All you have to understand about HFTs are, you can't see them, but they're there. And just because you can't see them and they're there doesn't mean they're always going to defend. Sometimes they'll defend. Sometimes they won't defend. It's hit or miss in most cases. You're seeing a market where every single dip has been defended, and you're convincing yourself and you're trying to convince me that we're never going to go down. We're going to go down eventually, but we're not going to go down until basically the institutions start selling and the algos start selling at the same time. What's happening now is the algos are defending all long positions and the institutions aren't selling. And that's why the market doesn't go down. If you want to break the back of the market, you have to have HFTs synchronized with retail and institutional money, and they're all directly selling in the same direction. And it's not happening. You're having cross currents all the time. HFTs are actually defending the market now. They're not like wasting the market or taking it down. And that's like, I want to throw that out there. But don't assume they're your friend, because they're not. They're mercenaries. They don't care about fundamentals. All they care about, okay, is scalping and mitigating risk, and that's it. So if the market blows, don't throw your screen and complain while you're long. An HFT that made you rich is an HFT that can make you poor. Easy come, easy go. Okay, what taketh, giveth, taketh away by these machines. This scenario, last but not least, it adds only pennies per share to a stock price, but spread over the entire market, it can total like $150 million per day. Okay, so the SEC controls were put in place to prevent this, but these measures have proven to be too slow to catch up with the lightning trade fasting. So the idea here is, does the SEC govern this? Do they oversee it? Yeah, they oversight, but they're feckless. It's like a police force that says, we're the police force, but they can't enforce anything. How are they going to enforce anything on this? By the time they figure out what's going on, it's already like 6 months too late. They're investigations. So to me, the SEC is feckless. They can't do anything about this. They can say we're the big brother, we're watching it, but ultimately they have very little impact altogether in what's going to happen day to day. And I can tell you this, as long as the market's up, the SEC is like, everything's okay. It's only if the market were to crash 2,000 points in the next 10 minutes would people go like, where's the SEC? Of course. When it's up, you don't say anything because 99% of people are long. It's only when it goes down that you demand to be defended. You're not going to be defended. Because the idea here is the SEC, okay, looks the other way when it's up, and when it's down, they can't do much of anything. So by the time they figure out what happened, it's too late anyways. So forget about the SEC. Roll the dice when you're trading every day is my attitude. And I look at algos all day long, and I make it a point, never, ever, ever trade against an algo, because I just don't want bids to collapse. I don't want to deal with that pain. Here they tell you how it works. Okay, nearest exchange, the HFT order races ahead of other orders because it's entering faster. And then you buy and sell and it flips and there's a penny-wide spread and it's all done. Like that is the normal like way things work in this business. This is like a normal way that this operates. I just want to throw that out there. So this was like a graphic I want to throw out. Now, let me move on and show you another graphic of how fast things are done. Just to give you an idea of how an HFT works. Okay, this is a theoretical entry of an order. It's all theoretical, I tell people. The order wasn't filled. I got duped. I put it at 61.90, it didn't get filled. It was a penny off. So you look at something like this, and you're like, okay, so what's the deal? Okay. Without means without the high frequency box. Okay. The red is the market without high frequency trading. The blue is the market with high frequency trading. You see that? So look what's happening with the with high frequency trading, the HFTs. You get a tighter market. See the spread? Look how the HFTs, they don't necessarily front run, but they're faster to adjusting their bid offers and then closing the gap is what they do. You can see this. The prices, okay, without the HFTs actually do what? The liquidity does what? It disappears or it thins out. And when liquidity thins out, look what happens. The prices then spread wider, less liquidity, less efficiency, greater risk. When you have a high frequency trading box, this is what you get. And this is a sell side and that's a buy side. On the sell side, the HFTs actually do what? They're shock absorbers. Without the HFT, the actual slippage of the stock goes that much further. You can see this. So the HFTs cut down on the slippage, they tighten up the bid offer spread, and they cut down on the time to execution. And all of it collectively translates into one thing: less volatility. Less volatility most days. So this assumes that the high frequency trading can curtail volatility. Truth of the matter, can. It can. It will curtail on the volatility. But if there's a fast moving event, this might not necessarily hold. This is just an example during normal business hours in a normal day with a contained VIX and the market's just zigging and zagging like today. Today, the market's just dead on arrival. It dropped, it settles in, and it stays there. This is a normal kind of like dead cat bounce day, and we're probably going to trade flat the rest of the day. That's the way I look at it. That's where this comes into play. This is what you likely see. Without the algo, okay, spreading wider and trading, greater volatility. The reason why the SEC and why Wall Street likes algos, number one, is they can execute trades faster, less human error, scalp faster, it's electronic, okay? It has every advantage to Wall Street. And then they're going to pitch to you, you need us. We provide liquidity, we cut down on volatility. Yeah, it cuts down on volatility in a normal day. But in an aberrant, abnormal day, HFTs actually add to volatility because they can systematically cancel bids and offers, create gaps, wide open gaps and crashes. So my answer to the people who say, you know, the HFTs are terrible, okay? My attitude is this to you. This is what I say to you, and here's the HFT, okay? High frequency trading. On a normal day, you love them. You know you love them. But on an abnormal, wild day, the market's down 250. You're going to hate HFTs because they ain't going to support you. They only support the market when it's at their benefit. If they see order flow coming at them like a tidal wave, they can cancel bids and drop this 200 points by the time you blink. HFTs are great in the normal line of business. Like on a day like today, oh, market's down 20, up 4. This is a normal, like plain vanilla day. So HFTs are good. Talk to me when the market's down 500, 400 in a day. You're going to go to Capitol Hill and wish they were banned. Because if you're long, they can just tempo control, cancel everything, and create a ripple effect and intensify the volatility. Now, let me continue upward and onward with more things that I want to add about algorithmic trading. Other risks, okay? Here's some other risks that are not that obvious about this, okay? One is called errant algorithms. And a lot of people get confused. They're not really sure what errant algorithms really mean, but I'll try to make sense of it as best I can. The dazzling speed at which most algorithm HFT trading programs takes place means that one errant or faulty algorithm, they can rack up millions in losses in a very short period. An infamous example of this damage of an errant algorithm, and Dawn remembers like it was yesterday because Kaufman was on the trading floor, okay, can cause that, is that of Knight Capital, Knight Capital, because thinkorswim used to clear through Knight Capital. It was a market maker that lost $440 million in a 45-minute period on August 1st, 2012. Okay, run that through your head. 45 minutes, 440 million on a rogue algorithmic program. So again, if somebody oversees the machines, or if machines oversee the machines, it doesn't mean that there isn't an errant program coding in the system or a trigger with technology. You saw how it was difficult for me to even log in to get in today to do this program. I actually have to reach out and get my computer cleared in the system because there are issues with the system. You saw that. Technology is what? Built to fail. Beware. With the omnipresence of algorithms, you're going to have days of errant algorithms that do things that are unintended consequences. Will it happen often? Probably not. I would bet my bottom dollar it's not going to happen often. Not. But just because it's not going to happen often doesn't mean it's not going to happen. That's my whole point, okay? It can happen at any time. So beware of errant algorithms. Here's another systemic risk. Tomorrow, we're going to talk about strategies. Huge investor losses. Now, forget about Knight Capital, which was a clearing firm, okay? We're talking about you, me, all of us who are retail traders. Check this one out. volatility swings worsened by algorithmic HFTs, they can saddle investors with huge losses. And you're like, do tell. Well, many investors routinely place stop loss orders on their stock exchanges at various levels. Now, I don't, but some people do. And some of them are 5% away from their current trading price. Okay. So if the market gap is down for no apparent reason, you don't even need a reason, okay, or even for a very good reason, these stop losses would be triggered. It can go through a price and you have a stop loss, it gaps through and it starts filling orders underneath the gap because the stop loss rolls to a market order. Once it rolls to a market order, it's going to fill electronically immediately at a price that you may love and most likely a price that you may hate. The thing is, it just feeds on itself and it feeds on itself and you can't stop it until it's like, oh my God, we're down 300 in the S&P. Once again, I keep telling you, it has nothing to do with like an economic event. It's not about fundamentals. It's a structural problem that is embedded inside the very nature, essence of an algorithm. And you can't turn back. You can't tell me, cancel it. Cancel what? You're not going to cancel it. If you put in that stop loss and it's filled, who's going to reverse that order? Nobody's going to reverse that order unless it's a flash crash that was duped by some like lack of transparency or some manipulation. If it's non-manipulative, it doesn't break the law. You can't just turn back the loss. You're going to have to eat it because you placed that stop loss. And it has happened on massive losses to investors. So to add insult to injury, if stocks subsequently rebound in short order after going through that stop trigger, investors would have needlessly incurred trading losses and lost their holdings. If you want to get back in, you got to jump back in and pay a way higher price. It's insult to injury, right? While some traders were reversed or canceled during unusual bouts of market volatility, like the flash crash and the night fiasco, I got news for you. Most traders were not. I know it's so hard for a lot of people to like absorb this. Most of the time, you're not going to get your money back. There are exceptions, but don't delude yourself into thinking like the exceptions themselves are basically normal because they're not, okay? For example, most of the nearly 2 billion shares that traded during the flash crash, they were at prices within 10%, okay, of their 240 close, the time when the flash crash started on May 6, 2010. And these trades stood only about 20,000 trades involving a total of 5.5 million shares that were executed at prices more than 60% of the way from their 2:40 p.m. price were subsequently canceled. Now you have to understand this. 5.5 million shares were reversed or canceled. But that's a mere pittance because at the time, it was estimated that 200 or 300 million shares were traded during that window. Were you the lucky one of that 5.5 million? That means you're less than 2% of the population who got your money back. Don't bet on it. If I were you, I wouldn't bet on it a second time. I wouldn't the word is like, I wouldn't go to the well too many times. Like you're going to be aware of one way or another. Like it's like these flash crashes, you always think like, don't worry, I'll get my money back. Not necessarily. Okay. Very small. It's very rare people get their money back. On August 1st, 2012, the New York Stock Exchange canceled trade in 6 stocks that occurred when the night algorithm was running amok because they were executed at prices 30% above or 30% below that day's opening price, which is just hard to like wrap your arms around. The New York Stock Exchange clearly erroneous execution rule states that the numerical guidelines for reviewing such trades. So it has to be clearly erroneous. And usually there's a committee who decides whether it's clearly erroneous, not you. Even when you think you're right, the committee may not agree. So you're up against powers to be that may be in your camp, may not be in your camp. The last thing I want to throw out, okay, is this: loss of confidence in market integrity. As my dad always taught me when I was a young lad, he says to me, you can lose everything. You can lose your house, insurance policy will pay you. Lose a car, crash, insurance will pay you. You lose confidence in the market, your reputation, you can't get that back easily. Sometimes it never comes back. In this case, okay, investors trade in financial markets for one reason. because they have full faith and confidence in the process and in the integrity. However, repeated episodes of unusual market volatility, like the flash crash, could shake this confidence and lead some conservative investors to abandon the markets altogether. So if you don't think that this could happen a second or a third time, okay, you think it's like, well, it's not going to happen. Okay, you got to start thinking through it again and again and again, because that's just nonsense. I'm not predicting it's going to happen. I'm not going down that path. I'm not going there. But I'm telling you, at any time, if it happens, I'm not going to sit here and go, wow. I'm not going to say, wow. I wake up every day, and once every, 20 years it happens. I would expect it once a year to happen, not just once every 20 years. So just be aware of what you saw here. Here's an example. In May 2012, everybody remember was called Facebook? It was called Facebook instead of Meta platforms. Facebook's IPO had numerous technology issues and delayed confirmations. While on August 22nd, 2013, the Nasdaq stopped trading for 3 hours due to a problem with its software. In April 2014, close to 20,000 erroneous trades had to be canceled following a computer malfunction at the ICE, the Intercontinental Exchange, at the ICE Group's 2 US option exchanges. It happens, people. Another major blowup like the flash crash could shake investors' confidence in the integrity of the markets. I remember during COVID, it was like all messed up. So what have they done to combat this? Okay, how do we combat this? Well, they have what's called kill switches. Kill switches that can stop all trading activity under certain circumstances. The Nasdaq switch provides an additional level of safety to counter algorithms gone rogue. Okay, so what are they called? Circuit breakers. The circuit breakers were introduced after Black Monday in 1987 October and are used to quell market panic when there's a huge sell-off. The SEC approved revised rules in 2012 that enable these circuit breakers to kick in the S&P indices if they tumble 7%. So if you're asking, what is the key figure? Don't worry about $200 or $300, useless on this product. The key number, 7%. They set the bar at 7%. The circuit breakers will go on. And that's 7% from the previous day's closing price. So this would have to fall about 700 points for them to actually shut the market off. But at that point, the damage will be done because it'll already have gone down to 5,000 if that were to occur. I just want to throw that out there. So the SEC approved these rules, and they will set the circuit breakers on at 3:25 p.m. Eastern Standard Time, which would halt trading-wide market for 15 minutes, okay? Now, the second key level is 13%. If there is a plunge of 13% before 3:25 p.m. Eastern Standard Time, that would actually trigger another 15-minute halt in the entire market, while a 20% dive would shut the market down for the whole day. So let's recap the levels. 7%, they shut it down for 15 minutes. 13%, they'll shut it down for another 15 minutes. You go 20% off where we are here, okay, the market's closed. If that happens, it's like 9/11. There's going to be a panic. The markets are going to open up the next day, probably down thousands of points, and the HFTs are going to go amok on this. This is the thing. This is what you deal with when you deal with markets that are not run by people. They're run by machines. And you're thinking to yourself, well, don't the people cause the panic? They do, but the machines exacerbate the panic. Some people will just throw their hands in the air and say, well, I've lived through this for 50 years. I'm okay with it because it'll bounce and I'll get my money back. The machines don't think like that because the machines live in the moment. The machines live in the split second. To a machine, like 1 hour is like a lifetime. Like 1 second is a lifetime. They only live for the second. They don't live for long-term investing because at the end of the day, they basically flatten out. So algorithmic high-frequency trading obviously is fraught with risks, the biggest of which is its potential to amplify systemic risk. Its propensity to intensify market volatility. It can ripple across the markets and basically stoke investor uncertainty, which markets hate, right? And repeated bouts of unusual market activity could wind up eroding many investors' confidence in market integrity. I will tell you this, what I've seen over the past 6 months, every time we have rogue days like this, that, down 200, people don't get frazzled. They get frazzled when it's repeatedly like that for multiple days, for multiple weeks. This was an occurrence on August 5th that basically lasted 2 days. That was 2 days and it ended. Since then, there's been nothing of the sort. You can't throw that at me and tell me that means anything because this hasn't broken any support level. The markets didn't freak out when we had a one bad down day in early September. The markets actually ignored it and went back to buy. Don't think it's going to happen every time the same. It won't. There will come a time where if this is, you have multiple 3 or 4 down days, gap, 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 and you're waiting for the 5th day of gap, Don will tell you, you better stop waiting for that 5th day of gap because it's not likely to come. The machines are not going to let it come. That's what I'm trying to tell you. So again, these are the systemic risks of algorithmic high frequency trading. The last thing I want to do tomorrow is I want to come back and talk about HFT strategies and show you it's all everywhere. It's in the indices, individual stocks, it's in currencies, it's crypto. I want to open up the Pandora's box and show you that it's in every single market, not just this market, the stock market, but it does have its anchor in the stock market because so many people gravitate towards it because of their lack of understanding of other markets and their comfort with this market. On that note, I'm going to turn this over to Blake Young, and I'm going to find out some way, somehow, to fix my computer. So, Blake, I'm not going to say I told you so, but when the market was down today, Blake, what did I Skype you this morning, an hour before the market started? What did I say the chance of the market going downward? 0 to none. I told you that. You're not getting the market down. You got to break this. You have to break technical indicators to do it. And we're not even close to breaking down at all. This is the more people short Blake, the more it's going to go higher. I'm telling you, that's my theory on this. I don't think it's going to go down at all unless we take out 5,500 and unless my technical model changes. So for me, Blake, I bought on the dips this morning and I'm happier for it. Sorry to Pat, but that's it. I'm not going to short this. No way. We'll see.
I'm not going to tell you I told you so, but
you haven't broken yet, but everybody's telling me to short. I'll let you know when my system breaks, I'll do it. See you later.
All right.